This is the current federal tax developments for the week of September the 26th, 2016. Current federal tax developments are brought to you by Nichols CPA Incorporated and your state society of CPAs. I'm Ed Zollers, and I'll be talking to you this week about some of the developments that took place in federal taxes. This week, we're going to look at a number of cases, actually, as the main topic, except for one little discussion that we're going to have about an IRS item. What we'll look at this week is the IRS is telling more and more of their own employees that they should not initiate contact by phone. We'll talk about the latest memo that went out that the IRS released regarding that first contact rule. We'll also talk about a couple of cases. First one, where a taxpayer was not found to have had a health benefit plan and therefore was really found to have a deferred compensation program, so the benefits received were taxable in that case. A taxpayer failed to present proof. He was trying to get a welfare benefit plan, claiming it was more than 10 employers, and he neglected to actually prove there were more than 10 employers in the plan. Minor detail. We have another silo transaction that bites the dust. Silo, sale in, lease out transaction that didn't give the tax benefits that the taxpayer had hoped for. And finally, we'll take a look at a case where the tax court looks at the always troublesome issue of whether a taxpayer was holding land for sale or was holding land basically for investment, or was holding it as an inventory type item when the property was sold. The question being, obviously, did we generate a capital gain or did we generate an ordinary gain? Now, this week, I've been going to be a little different this week because there won't be any video of me because I'm not really any place where I can shoot it very well. I'm actually managing, or you may hear in the background, a couple of loads of laundry. I just got back in from a trip where I was in Sioux City, Iowa this week, speaking to CPAs from South Dakota, Iowa, and Nebraska. And I'm getting ready to fly out early the next morning, it'll be Sunday morning, to go to Bismarck, North Dakota. So I have very little time in between here to go set up in my normal location where I would broadcast from. Can't really manage this laundry and stuff from there. So if it sounds a little different this week, I'm using a different microphone, a headset, and it may also, obviously, we're going to have to just live with slides for the week, but hopefully you won't find that too disconcerting. Now, I wanted to remind people, I said lots of travel. We do have some things coming up after the October 15th filing deadline that I wanted to remind you of. I've got a personal road trip, shall we say, for the Iowa and Montana Society of CPAs. I'm going to start out on October 24th and 25th in the Clarkston, Washington, Lewiston, Idaho area. And I'll be just giving 2 days worth of current federal tax developments. First day on individuals on October the 24th, the second day on businesses on October the 25th. I'll then drive over to Missoula, Montana, and it takes a little while to get there, so actually we'll have 1 day in between. But October 27th, I'll give a course on construction contractors and one on depreciation, repairs, and fixed assets on October the 28th. Finally, following that weekend, I'll come back on October the 31st. I will be speaking in Twin Falls, Idaho, and I'll be doing a current federal tax development for individuals on that date, and then on November 1st, pronounce it right, for businesses. So if you're going to be available there in those areas and you're able to come out, look forward to seeing you there. It's kind of nice getting on the road and seeing people live as opposed to just always broadcasting things. So hopefully we'll find an enjoyable time, and hopefully we'll be able to go over some of the neat things that Congress, the IRS, and Congress has done less this year, but the IRS and the courts have done this year, and talk about maybe what's going to be coming up in the future. Of course, unfortunately, those will all be before we have the presidential election, but we can at least speculate on what's likely to come after the election. Well, first up this week, we're going to talk about an IRS announcement. This is a memorandum, SBSE 0409160023. And this is where the IRS again has gone down the issue, or gone after the issue of employees who are initiating contact with taxpayers by telephone. As you may remember, back earlier in the year, there was an announcement from on high at the IRS that they were, we needed to stop doing that after it was brought up in an interaction with practitioners and the taxpayer's advocate in Iowa, that in fact IRS is regularly making contact by phone to initiate audits. Well, the Small Business and Self-Employed Division finally released their memo. It appears that the actual guidance went out back in May because the memo refers to that date. But that also now has guidance that small business exams will not be started by phone again. The IRS now charges field agents are required to initiate all exams by mail. The letters will go out by mail for the exams, and the agent is to wait at least 14 days for a response from the taxpayer before attempting to initiate contact via other mechanisms. As we all know, the reason for this is pretty simple. Scam phone calls from people who claim to be representing the IRS. Unfortunately, those have gone up considerably. We've seen a lot of those, and at least here in the Phoenix area, I notice they go in cycles where we seem to go for a while with a whole bunch of them, then they quiet down, then the cycle starts again. That problem is coming. Oh, by the way, now apparently there's also an email scam going around where they're claiming to be sending people CP 2000 notices via email, which of course the IRS doesn't do, but you know, taxpayers are a little bit, shall we say, not aware of the differences sometimes. So the phone scams continue to run wild. It's important that you get these memos together and probably start considering how you're going to discuss with your clients what would or would not be a potentially valid contact from the IRS. Certainly, you want to remind them once the exam has started, phone contact is likely to happen, but generally it should be coming from the IRS and related specifically to the exam issue in front of you. It's a little dangerous. You don't want to tell them if they're under exam that every call now is from the IRS, but you tell them essentially calls where they're talking about this exam, presume are most likely from the IRS, and especially if you have a field exam or any other exam with the local office is handling it where you're dealing with a specific person, then generally it should be that person that's calling. So we can inform our clients this memo, SBSE 0409160223, gives you guidance there about how they'll start a small business exam. Next up, we're going to have the case here of Barnhorst versus Commissioner. This is Tax Court Memorandum Decision 2016-177. It was issued on September the 20th. This particular case deals with the question of whether the benefit paid by a program established by the taxpayer in 2010 represented payments under an accidental health plan, and if so, were they basically benefits not related to the absence from work, in which case they'd be excludable from income. The IRS said, well, we think this is really deferred compensation, and the tax court agreed with them. What's the problem? Well, Mr. Barnhorst set up a plan early on in his career when he formed his own law firm. He set up a plan that essentially got it into a contract with a offshore insurance entity that was formed. And this insurance entity essentially wrote a policy that was supposed to provide for payments to this gentleman in the case of certain disabilities. Now, the interesting aside is that this account was tied to a Charles Schwab account too. So there was a Schwab brokerage account. Now, in this case, Mr. Barnhorst really got disabled. He was diagnosed with cancer. The cancer eventually took his life. And for a while he continued to work, but eventually he had to stop working. It had been a prostate cancer that had apparently grown well beyond just the prostate. So they had to basically take out a bunch of other tissue, and that had the effect of causing him to have numerous problems, shall we say, that were were more than just, let's say, an inconvenience. They were significantly inconveniencing, is the best way to phrase it. So Mr. Barnhorst eventually filed for a claim of disability policy. The payment was made. The taxpayer claimed the payments represented the health care benefit did not pay tax on them. The IRS, after Mr. Barnhorst died, that's why it says the estate of Barnhorst, the exam finishes. The IRS position was the payments that were made were deferred comp. And the tax court agreed with that. Why? Well, the plan on its face appeared to meet the requirements. Clearly, it was paid when he was disabled, and it appeared to have different benefits depending upon how you were disabled, if you were totally disabled, partially disabled. There are all these various ways that you could trigger the benefit. But the interesting quirk was Whether he was disabled or not, there were all kinds of ways. If the thing terminated, he had the right to roll over any cash balance left in the plan, 97% of that, shall we say, to convert that to a life insurance policy. Also, if he was disabled, we had all these strange payout options in the way they'd be paid out and how much would be paid out. But there was always a guarantee that he would eventually be paid 97% of the cash value in the account, and we would never be paid more than 97% of the cash value. The tax court found that, well, despite the dressing of this as a medical plan, in reality, this thing was a deferred compensation arrangement. And, dressing it up and claiming and, trying to make it look on paper like a plan that was meant to be a plan to provide for, disability benefits in the case he suffered certain medical conditions, didn't change the fact that it simply didn't qualify as such. Next up, another time the taxpayer is going to have a little problem here. This is a case of Schechter versus Commissioner. Tax Court Memorandum Decision 2016-174. This decision came down on September 19th. This particular taxpayer, this is yet another case of a taxpayer claiming that they have established a Section 419A F6 plan. Now, those plans are welfare benefit plans, and they've been pushed quite heavily by a number of insurance, let's say, agents who are specialized in aggressive tax planning. And we've seen these come from time to time. And the point is, they put together this program. And while this is a welfare benefit plan, it's supposed to pay for disabilities and various other things happening, and also offer a death benefit of sort if the individual dies. What it's really doing is using this as a way to buy a large life insurance policy to get a full deduction for it. In this case, we established a plan for Mr. Schechter. Mr. Schechter had essentially paid $450,000 for a single premium life insurance policy. Generally, under 419 Cap A plans, you're not allowed to take more than what's called the qualified cost as a deduction. And the IRS and the taxpayer agreed qualified cost for this, because there really was no cost for the benefits that would have been required, would have been zero if it doesn't qualify under the special 10 employer rule. Now, to 419 Cap A F6, if a plan has 10 or more employers and it's not experience rated, that means that, we basically have the idea of that is that all 10 employers put money in a pool, and then whoever's employees, have the issue arise that the welfare benefit plan would pay for, they get the money, and nobody's assured that they're only going to be paying for their employees, or their employees are going to get the benefit equal to what's put in. We don't separate that out, nor do we separate out it for each individual employee. Well, these plans are almost always structured so magically, the individual structuring it always ends up with that life insurance policy in his name after we're done. But the tax court didn't have to go there in this case. In this case, the plan provided that the taxpayer had the right to get records from the plan administrator that showed the information necessary to prove qualification. But the taxpayer never asked for information showing how many employers participated. They just assumed there was more than 10. Well, assumptions don't work. They also, interesting enough, he came up with, wait, I got this letter from an attorney that says this plan works. Well, unfortunately, that letter from the attorney, it just simply assumes there's more than 10 employers in there, but never actually indicated that the attorney had actually checked to make sure there were more than 10. And the tax court had some nasty words there for that case, where this appeared to be an attorney working for the promoter, noting that essentially, you can't just hide behind this letter from an attorney that, that assumes facts or just says this is the fact, but doesn't tell us how the attorney arrived at that. You've got to prove the facts. So the tax court never got to the rest of the problems there might have been with this plan. They said, you can't show there's more than 10 people. There's not more than 10 employers. Sorry, guys, this plan doesn't work. Next, We're going to take a look at another taxpayer. This is a bad week for taxpayers, shall we say. This is the case of Exelon Corp versus Commissioner, 147 TC number 9. This was the case of a sale-in, lease-out transaction. In this particular case, this involved Exelon had acquired another company, merged with another company, and they needed to get rid of a bunch of fossil fuel power plants. Now, when they sold those plants, it would generate a $1.6 billion, not 16, $1.6 billion gain. Well, even at 1.6 instead of 16, that's still going to be a lot of tax to pay. So they thought they would like to find some way to defer that. Well, an international accounting firm came to them and said, hey guys, here's what we can do. We can set up this silo transaction where you will 1031 exchange your power plants for power plants held by a public utility. Now, at first, the first thought about why they didn't do that was they didn't want more power plants. Well, no. The public utility would agree to lease those plants back. Now, that is what's called a sale-in, lease-out transaction. And this case, we're using public utilities because they don't particularly care about the tax consequence to them, theoretically, from this sale transaction. But the way it was structured was this. In essence, under the terms of the lease, we put lease in quotes, the lease was an absolute triple net lease. They were responsible for nothing under the lease, and the utility had basically the public utility had a right to get the building back at the end. Now, that in and of itself is not a problem, except if they didn't take the building back, they didn't buy the power plant at the end of the lease for an amount that was listed. What ended up happening was they had to spend all kinds of money to bring the plant up to the standards of when they first started leasing it. And it presumably, as the court noted, that cost would have been very, very substantial. So the economics were such, the court said, that it was obvious that the public utility was virtually forced to take the property back at the end of the lease. Everybody assumed that was what would happen. The court said because of that, Exelon never had the benefits and burdens of ownership. What they really had here was a secured loan to the public utility secured by the power plant. And in that case, they said, well, you can't 1031 exchange, real estate, used in your trade or business. You can't 1031 exchange that and take notes in exchange. That's called an installment sale if you actually did that. And in this case, it wasn't even that because they got the cash and then they bought the notes. So all we have now is just, we sold our power plants and we bought notes. Therefore, the tax court held they were owed tax on the entire gain from the entire $1.6 billion gain was taxable to Exelon Corp. Finally, let's take a look at the case of Borey versus Commissioner. The Borey case, 118 AFTR 2nd. This is 2016-5207 paragraph in AFTR 2nd. This is an 11th Circuit decision. In this case, the taxpayer had acquired land with the intent to develop that land. After doing so, and they had a very specific way they were going to sell and subdivide this land. The problem was after they did that, the county eventually, before the development, before they were able to start really selling the property, the county changed the requirements to require a whole bunch of infrastructure improvements to be made to the property if you were going to develop it. The problem was, though, they had a very low density development, and the improvements that be required effectively only would work if you had a much higher density development, which is not something that they were intending, nor it appears even able to pull off at that time. So the taxpayer, in this case said, okay, they took a look around. Now, what they said was they started taking moves to get the property approved and set up for a much more high density development. So they continued to work down that road. They also discovered that the adjacent parcel, a property adjacent to their property, The developer there was going to do a high density project. So they approached that developer, this taxpayer did, and was able to sell the property. The taxpayer claimed that this should be a long-term capital gain. They said, even though clearly we acquired the land, I acquired the land with the intent to develop it and sell it, therefore being property held for sale in the normal course of my trade or business. But when the day I sold it, I was simply trying to get the highest price possible. It became an investment because of what the county did. The tax court said, well, let's take a look. Section 1221, which defines a capital asset, tells us that effectively every asset's a capital asset. However, then it lists a series of exceptions. So we start with including everything, and then we start taking things out. One of the things we take out of the list is any property that is, held for sale, that is, was held for sale to customers in the ordinary course of business. The tax court found that, okay, it was clear when they bought it, and the taxpayer agreed that that was what this property was. It was intended to be used that way. The taxpayer claimed, though, that, the only thing that really matters is what my intent was at the instant of sale. The tax court said no, or I shouldn't say, the 11th Circuit said, no, that's not right. They said, if you view it that way, at the actual instant of sale, everybody, including a home builder, has the intent to get the highest price possible. So we can't really do that instant of sale test. Rather, we look at the general purpose of the acquisition and holding why we held the property. The 11th Circuit found in this case that we intended to develop the property even after the law changed. The law changed, the court said, which is important here to distinguish it from some other cases, did not say it was illegal to develop the property. It just changed what you had to do. It didn't make it impossible to develop the property because obviously the other party who bought it was able to do so. It may not have been a development these people were one they'd like to do, but this guy continued the work and did the work necessary to set the groundwork to allow it to be developed. The 11th Circuit said, with these facts, this is ordinary income, not a capital gain. We did not have a true transfer or change of that where we held it for investment only. Now, my own comment on this is it may have been a very different result had the taxpayer, after the county changed the rules, set back, stopped development on the land, and effectively just sat there and then maybe held the land for 10 years. That would be evidence that you had truly converted it to an investment property, not a property that's being developed. But in this case, the taxpayer kept moving down that path, and in reality, they got rid of it within a reasonable time after their development plans no longer could work. That just makes it look more like it's development, even though something may have happened in the interim. The court said, absolutely, we do not agree with the theory that we only look at the why we were holding it right at the instant of sale. So in this case, this is always a tough call, and be careful because clients like to have their cake and eat it too. Whenever they lose money on a deal, they want to say that it was inventory, they were a developer. Whenever they make money, they have a tendency to want to treat it as capital gain. You need to be careful because, you've got to look at the facts of the case and make sure the facts justify the position you're taking. Well, we're getting back into, that time of year. You've got your October 15th deadlines coming up, I know, but right after that, you're going to have to get right into tax planning season. And so you need to understand and take a look at, lots has been going on, I know, because I have to write about it all the time. During all that time, from the beginning of this year, all the way through October 15th, when you finally finish that last extended return. You need to get up to speed here quickly on what's happened and what's changed during those 9.5 months that you were with your head down, processing and doing returns, because coming up here very shortly, you've got to do all that year-end planning. Be sure to check your state society's live CPE catalog to get live specialized training. This is 8-hour training with a live person you can ask questions to. That's the type of training you simply don't find most any other place. And it's a type of training in specialized areas that just, this is the one place you can sit down and ask somebody and talk to other CPAs in your area that have these issues so you can discuss these matters. Check your state catalog. Check for what's available and be sure to sign up. This has been the current federal tax developments for the week of September 26, 2016. Be sure to catch our daily updates at the currentfederaltaxdevelopments.com website. You also can download a PDF with articles with all of today's topics on the weekly updates page. Just click the weekly updates page. You'll find it there. Be sure to send your questions and comments to me. If you have any questions or comments about this week's podcast, you can send it to me at edzollers@currentfederaltaxdevelopments.com. You can also follow me on Twitter at edzollers.com. In the coming week, as I said, I'm going to be heading to North Dakota for the North Dakota Conference for their annual meeting from Monday and Tuesday. Thursday and Friday, I'll be talking to CPAs in Boise. So we'll do a couple days of classes there in Boise, Idaho. And the following week, I will head to Cleveland, Ohio for 2 days. I have a nice busy time before I finish up my last extensions. So if you're going to be available in all those cases, be sure to check for those courses. North Dakota, it's going to be kind of late to sign up for probably at this point, but hey, you probably could get in if you get in right away. I'm sure if you showed up Monday morning, they'd find a way to register you there. Certainly, though, you have time to pick up the Idaho courses or the Ohio courses. Check the Idaho catalog and the Ohio catalog for the courses I'll be doing there. And I look forward to seeing you all next week here on Current Federal Tax Developments.